The Honest Company Inc., HNST, is currently trading at $3.795, reflecting a minus 1.17% move lower in today's intraday session. That figure, a modest dip of less than 1.5%, appears rather benign on the surface, but it masks the deeper tension that defines this stock. The tug-of-war between impressive operational execution and a persistently skeptical market, a skepticism driven by the flatlining of top-line revenue growth. The immediate, unexpected insight here is that while the market is focused on the minimal revenue growth of less than 1% reported in the last quarter, a narrative that suggests the company isn't truly expanding, the real story is the record-high gross margin of 40.4%. This is an astonishing demonstration of disciplined cost management and strategic channel shifting that fundamentally changes the profitability profile of the business. Investors are so conditioned to see growth at all costs in a younger consumer brand like this that they are completely missing the profound and difficult shift to a genuinely profitable, financially sound business model. This creates a fascinating disconnect between expectation, which is still stuck on high-growth narratives, and the reality of a CPG company that has finally figured out how to generate real net income, even if its sales figures aren't lighting the world on fire just yet. The common expectation for the Honest Company, since its initial public offering, has been that its celebrity founder-driven brand cachet would translate into a soaring top line, positioning it as a fast-growing player in the clean consumer goods space, often spoken of in the same breath as other digitally native brands that transition to retail. However, the reality of the daily trading volume and the stock's performance, which has seen a 52-week high near $8.97 and a low of $3.32, speaks to the volatility and uncertainty surrounding its actual growth trajectory. Today's slight downward pressure, consistent with recent weeks where HNST has fallen on broad market weakness and consumer spending worries, reflects that general market sentiment. Analysts and many individual brokerage account holders using platforms like Fidelity, Robinhood, or Interactive Brokers for their online investment decisions tend to focus heavily on quarter-over-quarter and year-over-year revenue expansion as the primary indicator of health for a brand like this. When the last reported revenue came in virtually flat, that immediately became the headline, leading to minor selling pressure despite the remarkable internal improvements. But what they are missing is the underlying shift. The fact that the company delivered its second consecutive quarter of positive net income, driven by a sharp increase in gross margin, up 210 basis points, suggests the management team is making difficult but correct decisions. They are moving away from lower-margin, higher-cost, direct-to-consumer Honest.com sales, which inflated the top line but crushed profitability, towards higher-margin retail partnerships. This is operating discipline in action. A quiet win that doesn't generate the same buzz as a major product launch, but matters far more to the long-term health of the stock. For an investor engaging in self-investing or using a platform like Schwab Intelligent Portfolios, this fundamental improvement in financial stability is a far more reliable indicator than any temporary sales bump. Looking closely at the recent market movement, the stock saw a dramatic plunge earlier this year, a 10% drop on a single day following updated cautious revenue guidance, despite the profit news. This is the classic expectation versus reality mismatch. The market expected a high-growth brand and punished it when management signaled slower growth, even if that growth was profitable growth. Conversely, the stock has also experienced moments of uplift, such as a recent rally after bullish analyst coverage argued that cost cuts and core category stabilization would drive improved profitability. This back-and-forth swing where the market simultaneously rewards cost control and punishes slow revenue is the trading environment for HNST. The institutional activity has also been mixed, with a noted institutional buy-in providing a recent floor for the stock, while significant insider selling, particularly from the CEO and other directors, over the past few months, has fueled the skeptical narrative. The volume today, sitting at over 1.7 million shares traded, even before the market midpoint, indicates that a substantial number of transactions are still being driven by this debate over value versus growth. Is HNST a discounted growth stock, or is it merely a slow-growth consumer packaged goods company? The trading says investors can't decide, leading to the kind of elevated volatility that makes this a tricky stock for simple invest-online strategies and a playground for active traders who use Interactive Brokers trading tools to capture daily price fluctuations. To understand the business model of the Honest Company, one must look past the initial perception of a celebrity-founded brand. At its core, HNST is a multi-channel CPG wellness brand focused on baby, beauty, and household products that meet its clean and conscious standards. The business is primarily split between diapers and wipes, which is still the largest segment, and its growing skin and personal care and household and wellness categories. The strategic pivot that has been paying dividends is the shift in channel mix. Historically, the Honest.com direct-to-consumer channel was a large portion of sales, but it came with cripplingly high costs for shipping and fulfillment, dragging down margins. The management team has intentionally de-emphasized this, focusing instead on scaling up higher-margin, more efficient retail distribution through major partners like Target and Walmart. This is why you see the gross margin at 40.4%, a clear result of this operational discipline and a move away from costly logistics. This figure places the company competitively within the CPG industry average, which is a major achievement from a position of chronic unprofitability. Past performance saw the company log significant losses for years following its IPO, a common feature for businesses prioritizing customer acquisition over margin from day one. Their full-year 2024 performance was the turning point, achieving their first full year of positive adjusted EBITDA as a public company, a massive swing from a negative figure the year prior. This data point, often missed in the daily stock noise, is the most powerful evidence that the management team's transformation pillars, brand maximization, margin enhancement, and operating discipline, are working. This is not simply about cutting costs. It's a structural redesign of the supply chain and sales strategy. The future outlook for Honest Company is now centered entirely on whether they can pair their newfound profitability with a return to top-line growth. The market's expectation is that they must do both, and soon. The reality is that the next growth phase is likely to be slower, but of higher quality. Management has reaffirmed its full-year 2025 financial outlook, projecting revenue growth of 4% to 6% and adjusted EBITDA in the range of $27 million to $30 million. The key catalyst will be the successful execution of the new higher-margin diaper launch and the continued expansion of the skin and personal care lines, particularly the sensitive skin portfolio, which is a high-growth category for them. New retail shelf space gains, particularly in non-core categories like adult beauty at major retailers, are also a crucial point to watch. They are facing headwinds, including potential tariff impacts and persistent macroeconomic pressures on consumer spending, but their strong balance sheet, ending the last quarter with a substantial cash position and no outstanding debt, gives them the financial flexibility to manage these risks and continue strategic reinvestment into marketing and R&D. The average analyst price target suggests a massive upside, forecasting a potential increase of over 60 to 75% from the current price, a forecast that clearly validates the belief that the margin story will eventually win out. This wide gap between the current stock price and the analyst consensus highlights the very definition of the expectation versus reality dynamic. The market sees an overvalued brand struggling for sales, while analysts see an efficiently run clean-label CPG business with substantial white space for item-level distribution gains and a strong brand that is now finally capable of generating sustainable profits. The core of the matter for HNST, then, is a trade-off. Do investors value immediate, albeit often unprofitable growth, or do they prioritize sustainable, margin-led profitability? The market has been treating it like the former, punishing the flat revenue. But the reality, as confirmed by the record gross margins and positive net income, is that the company is behaving like a fundamentally sound CPG business. This is a crucial distinction for anyone using investment help, whether through intelligent portfolio or an individual brokerage, because it shifts the analysis from a momentum play to a value turnaround scenario. Comment below how many products from the Honest Company you or your family use regularly and what your investment thesis is for HNST, growth or profitability. The long-term authoritative outlook suggests that the management team's discipline in achieving profitability first, even at the cost of slower initial revenue growth, is the correct formula for long-term shareholder value. The immediate expectation for a high-flying growth stock remains unfulfilled, but the reality of a structurally improved, profitable enterprise is a much more solid foundation. The challenge now is to convince the skeptical public and the algorithmic traders that a healthy 40% gross margin is more important than a temporary dip in the top-line narrative. The story has fundamentally improved from a financial health perspective, and the next quarters will determine if that health can finally translate into a higher stock price.